Ladies and gentlemen, finance aficionados and seekers of investment wisdom, gather around as we dive into a treasure trove of market sagacity found within the pages of Security Analysis by Benjamin Graham and David Dodd. Let's sift through this financial Bible, not just for the insights that have shaped the world of investment, but also for the nuggets of wit and wisdom that still ring true decades after they were penned. 1. An investor, not a speculator. Graham and Dodd draw a clear line in the investment sands between the investor and the speculator. The investor plays the long game with thorough analysis and patience, while the speculator gambles on market mood swings. It's akin to the tortoise and the hare. Slow, steady, and analytical is likely to win the race. Quick and emotional can trip on market volatility. The authors advocate for investing, not betting. Remember, folks, note the tortoise. It carried its own shield to the finish line. 2. Intrinsic value, your financial compass. Our investment maestros stress the importance of intrinsic value, the real underlying worth of a security as opposed to its current market price. Determining intrinsic value is akin to being a financial Sherlock Holmes, looking for clues beyond the market's smokescreen to uncover the true value. It's not about buying at any price, it's about buying with the assurance that you're paying less than what the asset is truly worth. 3. Margin of safety, the investor's safety net. If intrinsic value is the compass, the margin of safety is the security belt. Graham and Dodd advise buying securities when there is a significant difference between the intrinsic value and market price. It leaves room for error because, let's face it, not all investment decisions will be spot on. Think of it as a financial airbag. It won't prevent the crash, but it sure will cushion the impact. 4. Mr. Market, your erratic business partner. Graham's parable of Mr. Market is a classic, painting the market as a manic depressive with mood swings that you can profit from. On his bad days, he'll sell you his interest for a pittance. On his good days, he offers a king's ransom for yours. The trick is to remain rational and take advantage of Mr. Market's emotional roller coaster without getting on board yourself. Just because Mr. Market wakes up feeling doom and gloom doesn't mean you should wear black. 5. Financial statements, the investor's playlist. Security analysis emphasizes the importance of a strong foundation in understanding financial statements. Income statements, balance sheets, and cash flow statements together sing the opera of a corporation's financial health. Tune into this music, decode the lyrics, and listen beyond the cacophony of market noise for investment aria that leads to informed decisions. 6. The importance of being earnings. Earnings, earnings, earnings. These are the crescendo in the symphony of any business. Graham and Dodd highlight that the future earnings power of a company is the heartbeat of its intrinsic value. A company with erratic or declining earnings is like a skipping record. It disrupts the melody of long-term investment success. Tune into the companies with a steady beat. 7. Diversification. Don't put all your eggs in one basket case. Security analysis preaches the importance of diversification. Graham and Dodd understood that even with the best analysis, you can't predict everything. Thus, spreading your investments across industries and securities is like adding various genres to your music library. One bad track won't ruin the whole playlist. 8. Debt, a double-edged sword. Our authors warn about the risks inherent with companies carrying too much debt. A firm with substantial debt is like a juggler with too many knives. One wrong move, and it could be a financial bloodbath. Assess the company's debt/equity ratio and ensure they aren't borrowing more than they can afford to repay or more than their cash flows can cover. 9. Defensive versus enterprising investing. Graham and Dodd categorize investors into two main types: the defensive, passive, and the enterprising, active. The defensive investor looks for safety and a decent return with minimal effort. Think of someone lounging in an armchair, occasionally glancing at their portfolio with a content smile. The enterprising investor, meanwhile, rolls up the sleeves, digs deep into financial data, scouts for undervalued stocks, and is more hands-on. It's classical versus jazz. One sticks to the notes, the other improvises. 10. The hex of high prices. Graham and Dodd make it clear that buying high with the expectation to sell even higher is a strategy fraught with peril. High prices often come with diminished future returns. And when the musical chair stops, as it inevitably will, you don't want to be the last one standing without a seat. The sweet spot isn't at the top of the mountain, it's in the fertile valley below. In honing our wit and wisdom with Graham and Dodd, let's remember that investment isn't just about wealth. It's about making informed, rational choices in a world that is anything but. They've told us to be the ballast in the stormy seas of the market. Equip yourselves with knowledge, protect with a margin of safety, and tune into the subtle frequencies of value. So, take these insights, not merely as commandments etched in financial stone, but as guiding stars in the investment cosmos. With an analytical mind, a patient heart, and a sprinkle of humor for good measure, trek through the terrains of the market with a map inked in Graham and Dodd's genius. May your investments be fruitful and your analyses keen. And always remember, in the thrilling casino of the stock market, it pays to be the house.